Hello everyone, my name is Venkatesh Gaikwad and in today's video I will try to give you a brief overview of the topic of taxation law. Now taxes are the fundamental block of our society because it gives finances to the government which government then helps and give it back to the society by whether it be education, constructing roads, etc, etc. So let us look at some basic principles of taxation law. So part 12 of the Indian Constitution deals with finance, contracts and property. So the part 12 of the Constitution specifically from Article 264 to Article 289 deals with the topic of taxation between the central and the state government. So basically it's union and state. So how are taxes managed and distributed among them is basically discussed in the part 12 of the Constitution of India. So why is the need of this part? So basically we need is finance for the government. Now how will they help the country if they don't get finance, if they don't get income, if they don't earn? So that is the reason why taxes are existed in the first place, and which is why the constitution includes finance topic in part 12. Now according to article 246, that is schedule 7, which gives three lists, and that are basically the powers or topics or subjects which are being allotted to particular government. So that is two parts, union government and state government. So this list includes various topics which are to be dealt by only state government, only union government, and the third list, that is concurrent list. Now subjects in the concurrent list can be dealt both by state government and union government. Now specifically in union list, that is entry number 82, that gave power to union government to levy tax on income other than agricultural income. Now the union list says that union government can levy tax on every other income except agricultural income. In state list, the entry 46 gives the power to the state government to also impose tax on agricultural income as well as other income. So this is basically a overview of how governments can take taxes on specifically incomes. Now, after the developments of the amendments, later came the Income Tax Act of 1961. Now, this act gave specific framework step by step and gave proper definitions to each and every term, and how the taxes should be collected are given in this specific act. Now next we move on to discuss part 12 in a specific detail, that is article 264, which is basically just mentioning that the financial commissions which is constituted through article 280. Further we move on to article 265, which says that taxes not to be imposed save by authority of law. No tax shall be levied or collect except authority of law, and should not be violative of any other constitutional rights. 265 basically says that taxes are to be put or took from only those specific subjects for which the law has permitted them. Other than that, they cannot levy a tax on that. Next, 266, article 266 mentions and gives the definition about a consolidated funds. Now what is consolidated funds? Consolidated funds and public accounts, basically these accounts includes all of the revenues, all loans raised by issue of treasury bills, and in repayment of loans all money received by government. Now what is basically consolidated funds is basically a list maintained by both union government and state government. Now they are basically holding all of the income that is received from taxes. Article 267 mentions contingency fund. Now this fund is maintained by both state and union. For the union, CF is maintained by president and finance secretary, and for the state it is maintained by finance secretary and the governor. Now what is the difference between consolidated funds and contingency fund? So contingency fund is basically an emergency fund which is only used in emergency conditions and not in any other conditions. Moving on, article 268 to 279 is relating to the distribution of taxes between union and state. So here we will learn that there is a line between what union is getting and what state is getting. So basically 268 to 279 we deal with what taxes are union government getting and what taxes are state government getting. So 268 says that stamp duty is levied by union but collected and appropriated by states. So what this simply means is basically the stamp duties or taxes that are collected by union but appropriated by states. So basically union is collecting them but the state is appropriating them. So it includes bills of exchange, checks, promissory notes as levied by government of India. Now after government of India collect these, they are basically giving it back to the state which it collected from for further use. So basically 268 says that Some of the stamp duties, some of the taxes which they collect are automatically reverted back to the specific state that they are collected from. Now these specific taxes are not part of the consolidated fund of India. Basically it is given back to the state itself. Moving on, Article 269 specifically talk about the trade part of view, which is taxes on the sale of purchase of goods and consignment of goods shall be levied and collected by Government of India, basically reverting back to 268, following the same principles that though the taxes are collected by Union government, they are basically divided back to the specific state they are collected from. And this specific measure are to be implemented from 1st of April 1996. And similarly, in Article 268, here also it is not included in consolidated funds. Now 270 is basically what 268 and 269 has left. So whatever left is to be distributed between both the state and the union. Moving on, Article 271 gives us two new terms, that is cess and surcharge. So it is basically a double tax, that is tax on a tax. Cess on one hand is basically sub-tax for a specific purpose and the amount goes to the consolidated fund of India. But a surcharge is not levied for a specific purpose but only allotted or taken from the people who belong to high income groups. So basically it is for the rich people. Next is Article 274, which is basically the prior recommendation of the President required to bills affecting taxation in which states are interested. So it is basically take the assent of the President whenever there is a bill that affects taxation where states are involved. Next is Article 275, which gives grants in aid. The Constitution has provisions for sanctioning grants to states or other units and goes to consolidated fund, and authority to grant is with the Parliament. So in cases, what happens is particular body, that is for example panchayat, requires a certain amount of grant or money. For example, there is a construction of dam, they required money, they don't have it. What they do is they ask the central government or state government to provide them fund, that is basically grants in aid. Moving on, that is Article 276. This article talks about taxes that are levied by state government, governed by state government, and also collected by the name, that is straightforward itself. Next is Article 277, that is any taxes, cesses, fees or duties which are levied immediately before commencement of the constitution by any state government or local body for purpose of state, despite being mentioned in the union list, can continue to be levied and applied for the same purposes until a new law contradicting it has been passed by the parliament. So in short, what it says is that, for example, one particular body is exercising some power before the enactment of the constitution, and just after enactment of the constitution it will still exercise the same power unless and until there is a particular law drafted in the parliament that contradicts it. Next, we move on to Article 279. This article deals with the calculation of net proceeds. So what is net proceed? Net proceed is basically the amount received after deducting all of the cost and expenses associated with the specific transaction. So it is basically the original amount, we can say. Next is 279A, that is a subclause of it. It is just a constitution and composition of GST Council which is given by the President. Next we move on to Article 280, which basically who will manage all of this? Basically it constitutes the Financial Commission of India. It is the main agency to resolve the fiscal disputed between state and center. So what we have learned till now or discussed till now is the duties that are divided, the rules that are divided between state and center at a particular point, and the Financial Commission of India will maintain that particular matters in their own hands, where they will distribute for few things for state and few things for center as related to the finances between center and state. It is basically a quasi judicial body and which maintains cooperative federalism. Now the composition of the agency is that one chairman is there and four members are to be appointed and elected directly by the president. What are the functions of this body? To make recommendation to president for distribution or allocation of net proceeds to taxes between center and state. Just like the main body is doing, is basically split things between center and state. Second is to establish principles governing the payment of grants in aids to states from CF of India. Now, whenever a particular local body needs some finance, needs some aid, financial aid, that are to be given from CF. Now, who decides that how much amount will be given? That is discussed by Financial Commission of India. Next is to suggest any necessary measures to increase the CF and development of panchayats in the state on the basis of recommendation of Financial Commission. Next, the President of India can also refer any financial matter which will help country to develop further and build a proper financial system. Moving on, Article 281 is basically recommendations of Financial Commission. The President shall cause every recommendation made by the Financial Commission under provisions together with an explanatory memorandum. Now, explanatory memorandum is the most important document here because it is to be given with the particular recommendation and passed through each house of the parliament unless it is approved. Next is Article 282, that is union or state may take any grants for public purpose. Whenever the purpose is public for the welfare, then only union or state can make any grants. Next is Article 283, receiving and using the CF of state and center. So it is basically the power of Financial Commission to receive the funds of center and state. 284 is any received money by court or officer in connection with affairs to be paid in the public account of India of respective state. Suppose we are giving court fees there. So this is some of the fees basically belongs to Financial Commission of India. These are to be deposited by the particular officer or court officer to their specific public accounts. Now moving on. This is a bit complicated, that is Article 285 and 289 which gives a doctrine. Now that doctrine is of intergovernmental tax immunity. Now what is this doctrine? This is basically the conflict between these two articles. Now what is it, we will see. Article 285 says that there should be an exception of central property from state taxation, which is void, and 289 says that exemption of state property or income from central taxation. So this is basically contradicting each other, which only parliament can later on change. Moving on, Article 286 restricts the power of state. First, the state cannot exercise taxation on import slash export, nor can it impose tax outside the territory of the state. This is straightforward. Next is only parliament can lay down principles to ascertain when a sale or a purchase takes place during export or import outside any state. This is basically a parliament decision and not dependent on the state. Third is taxes on sale and purchase of goods at are of special importance can be restricted by the parliament, and the state government can levy taxes on these goods of special importance subject to the restrictions. So this is basically that parliament can restrict the state government from collecting a specific tax or put restrictions on them. Now Article 287 and 288, that is exemption of taxes on electricity and exception from taxation by states in respect of water or electricity in certain cases. This is basically straightforward. Moving on, what is the scope of the tax laws in India? So what are the types of taxes? We know that there is indirect tax and direct tax. Direct tax, we can say it is income. Indirect tax, that is basically GST. What are the constitutional provisions that are basically we have discussed right now? Next is center and state relation. In the constitutional provisions itself, we have discussed what is the relationship between state and center in accordance with collection of taxes. Next is what are the administrative bodies. So basically they are Central Board of Direct Tax and Central Board of Indirect Tax and Customs. These are basically some of the important bodies that handle this matter of collection of taxes. Now next, what are the reforms that we have seen in the collection of taxes? So basically GST we have seen in the regime of Modi ji, he have put the scheme of GST. Next, what are the judicial statutory tribunals? That is ITAT, Income Tax Appellate Tribunal, and CSTAT, that is Custom Excise and Service Tax Appellate Tribunal. So whatever the matters or disputes regarding the tax collection will be going to these two tribunals. Now, what is the difference between tax and fees? So there is a very thin line between tax and fees. Tax on the one hand is compulsory financial charge imposed by government on individual business or any other entity, whereas fees is a charge for a specific purpose. So for example, there is court fees, there is educational particular form fees. So this fees is a fees, but what tax we are giving on income is a tax. So this is very thin difference between both of them. Moving on, these are the two terms that are very important in the Income Tax Act. And when we are studying tax, we should know these terms. So basically, revenue receipt and capital receipt. So revenue receipt is recurring in nature. So what is recurring in nature? For example, we can say income. Income we get on monthly basis. Salary, not income but salary. Salary we get on a monthly basis. So that is recurring in nature. Now what is non-recurring in nature? For example, we get a grant, we get a aid, we get financed. So that is for a huge, so for example, huge capital comes in business. So that is capital receipt. Moving on, receipts which do not impact the asset liability status of government. So that is a balance between them. Now, in a capital, there is a huge income that is directly coming. Sometimes there is no income. So basically, it creates a deficit or a distance in between. Now, this is the reason why there is a structural failure between the asset and liabilities of government. So next points are basically straightforward. That is, whenever collection of revenue receipts is there, it do not give any problem to the government. Whereas on capital receipt side, there is a huge problem to the government because there is a huge capital that is directly coming to them. Next, revenue receipt. More the revenue receipt, good the financial health. More the capital receipt, bad the financial health. We are talking about country in this particular matter. Next is increase in incomes, increase in liability. So whenever revenue receipt is more, that is collection of tax is more, we can reduce or we can deduce that income of a particular person in that country is more, which is the reason he's paying tax. Now when the capital receipt thing is there, which is being there more, there is an increase in liability of the government, which is basically bad for a particular country. So these were the constitutional provisions regarding the income tax or tax related system between state and center. Next, there is a very important point, and whenever we are studying taxation law, this is to be studied no matter what. That is Income Tax Act of 1961. So what is the background of this act? How did this act came in the first place? So basically it was first introduced in 1860 by a British ruler named Sir James Wilson, who later became the finance member of Indian Finance Committee at that time in the British period. So basically it was the mutiny of 1857 which gave rise to the particular income tax thing because British was suffering at that time. They needed a temporary solution to solve their finance problem. What are they going to do to solve their finance problems? So basically they divided income in four major categories. That is, one, salary and pension, interest on securities, income from land and property including agricultural income, and income from business and profession. So after division of the proper income, they came to enact the Income Tax Act of 1886. Now, what was the aim of this act? The aim was to be a permanent and main source of government revenue, that is East India Company revenue. So they needed finance, which is the reason that they wanted to create a permanent source. So what they can do, take general people's money by income tax. So what are the features of this 1886 act? That is, agricultural income was exempted, though we know they have categorized it, but in this act it was exempted. Next, the profits of company East India Company was also at a flat rate of 10%, they were to be taxed on. Later this act was amended many times, that is in 1903, 16, 17, and in 17, particularly 1917, where super tax was imposed above rupees 50,000. Now after a particular development, the Income Tax Act of 1922, it basically says that from Chelmsford reforms made a distinction between functions and resources of state and central government, and income tax became the primary income source. So it basically streamlined the entire procedure of income source for government. So what are the features of this act? Basically, tax rate were to be fixed by the Finance Act, which was passed every single year. Now this was not seen before, that Finance Act will be passed every single year. Next, principle of assessment of previous year's income during the current year was accepted. So we are seeing that there are small developments coming in the Income Tax Act. Now we are seeing that there are small developments coming in the Income Tax Act. Now from 1939 they basically created a slab system. So whatever percentage of tax to a particular percentage of income. Next we move on. That is our main, that is Income Tax Act of 1961, which we are following till date. So on 1st April 1962 it was applied to all over India. So why 1st April? Because financial year starts from 1st April to 31st March. That is the reason. Now the Income Tax Act of 1961 is a comprehensive set of laws that oversees various tax rules and regulations in the country. It ensures that every year's taxes are timely, rightly levied, collected, administered and recovered for Indian government. So this act includes 23 chapters and 298 sections. So now what is income tax to a whole? In the act it is not specifically mentioned, but we can deduce that income tax is a direct tax levied on the taxpayer's total income for a specific financial year. This act outlines a structured process for determining and collecting this tax. Now there are basically few more definitions given in that. Is income determination. So this act categorizes income into various heads, and that heads are basically with specific provisions for each. Now we can categorize income on different people with different parameters. Person who is doing a job gets a salary. Person who is doing a business gets a profit. That is income for him. For first, salary is the income for him. So basically headers are given and income is classified for the particular type of person. Next, what are the exemptions? Exemptions are basically agriculture income and scholarships. So there are many more than that, but these are basic examples of what are the exemptions in this. Now what is deduction? This allows for deductions from gross income for expenses incurred while earning that income. So of course there are in business there is few expenditure, then we get income. So in income also, what is the profit? We are getting income of 1 lakh, but expenditure is 70,000. So we cannot say we earned 1 lakh rupees, we earned only 30,000. Rest 70,000 is our nil. So that is why that is deduced from the Income Tax Act. Next is section 30 to 37. These sections detail allowable deductions for various expenses incurred in a relation with specific heads of income. So these 7 sections basically deals with what are the deductions in a particular set of income. Next is the tax rate and tax payment. Tax rate is basically slabs with different income levels and different income tax percentage. And what is tax payment is taxes are paid in advance with TDS system, that is tax deducted at source or directly to the government as a final tax liability. Moving on, what is income is basically given in the section 2 subsection 24, not explicitly defined, but income generally refers to any monetary benefit, in simple words, or gained received through year. Now to determine an income we have to take 2 years into consideration, that is previous year and assessment year. Previous year is basically the financial year preceding the assessment year where the person has earned that much amount. In the assessment year, it is calculated the income, the total income of the person in the previous year, and on that he is assessed and he has to pay that particular income tax in the assessment year. So these are basically few terms regarding income and the particular year. Next is the distinction between capital, revenue receipts and expenditure. Now these terms we have already seen. These impact taxability by a lot. Now we know that capital receipt and revenue receipt. So let's just skip that and move on to capital expenditure and revenue expenditure. So now expenditure incurred to acquire a long-term asset, that is capital expenditure, and expenditure incurred in earning income, it is basically revenue expenditure. So what we have discussed just before slide is basically what revenue expenditure is. Now this is just deductibles that we have seen before. Moving on, what is a residential status? Now residential status, as the word suggests, is the status of a person who is residing in India or outside India. Now there are two categories. First is special category. In each of these three conditions that are given, one is a common thing, that is person should be in India for 182 days. First condition is an individual leaving the country in previous year. Second condition, an individual visiting India in the previous year. An individual who is member of a crew in a ship. So we are considering that these three are the special reasons, but all of them must include that for a period of 182 days, the person should be in India. So in general category, it is basically for a resident only, 182 days in the previous year. Then the next point is 60 days in the previous year and 465 days in previous 4 years. These are basically conditions that how much particular time a person must reside in India that is liable to pay a particular income tax to the government. These are basically conditions for the residential status. Moving on, what is the basis of charge that is given in section 4 of the Income Tax Act of 1961? First is income tax is an annual tax on income. That is, it is given annually in a particular financial year, not monthly, not weekly. It is a particular financial year. Next is tax is charged on every person. Now this person may include many people in general. That is individual, Hindu undivided family, a firm, a association, local authority and others as well. Third point is income of the previous year is charged to tax in immediately following year at the tax rate applicable for assessment year. Now this is basically the point that we have discussed earlier about the previous year and the assessment year. Income is of previous year which we are assessing and charging tax in the current year, that is assessment year. We are charging tax of the previous year in the current year. That is basically the basis of charge. Now last point is scope of total income. Total income means whatever income that is there in India deemed to be received in India, whether the person is working outside or here in India, but the income is to be originated from India, he is to be charged with income tax. So this is basically the scope of total income. And with this, I have concluded the topic of principles of taxation law, which is a very important topic in the legal field. Thank you.